These are two types of stocks which every investor needs to know. In case you are investing, for example, at the Nairobi Securities Exchange, it is either the stock you are purchasing is trying to make you richer by increasing in value, or that stock you are purchasing is trying to pay you cash while you own it. It's only those two options, which are simply called growth stocks or dividend stocks. So you can either have a growth stock or dividend stock. And that is what I want to talk about extensively in this video, for you really to understand these types of stocks deeply, or these types of shares deeply, and also see how you can capitalize on that particular understanding to be able to benefit from the stock market. In case you are new here, you are much welcome to this particular channel. My name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos like these each and every day. In case you like the videos I'm making around investing and making money, kindly consider subscribing to this channel. Down there is a button called subscribe. Click that button to subscribe for you not to miss out on any of the videos I'm uploading each and every day. And I will still add it, drop a like on this video. Thank you for subscribing and also liking this video. So in this video, I'm really going to dig deep for you to understand which of these two types of stocks, which one is riskier, and even most importantly, which one is going to work for you depending on your age. Because also I believe different age groups or age brackets need to be utilizing these different stock types to their advantage, okay? And with that, growth stocks are typically those stocks by companies which are focused on their business expansion, okay? And that typically says or means these company stocks, they typically utilize almost entire of their profit to reinvest back to their business. They usually pay very little to no dividend. And this is so because they have business demands, or they are either starting point or approaching the peak of their growth curve. They need to continue expanding their business, maybe get more employees, open more branches, deal with the debts they have, you name it. And that leaves them with no option but to utilize most of their profits to be able to sort these business affairs instead of paying shareholders out there. And then the second type of stock or share is the dividend stock. Dividend stock are typically those stocks by companies which regularly do pay dividends. Dividend is basically what a company pays its shareholder as them being part owner of the company. Remember, you have invested in a business, okay? The business is conducting its business. For example, in Kenya, maybe it's in telecommunication, it can be Safaricom. Maybe it is in manufacturing, it could be EABL, right? It might be in banking sector, it might be Equity Bank. They are doing whichever business they are doing out there in their respective sector. At the end of the year, maybe they make a profit. Let me say, for example, 10 billion Kenya shillings, right? The management and directors of a particular company might decide they want to maybe shove off 20% of their profit they made that particular year to be able to distribute it among the owners of the company, simply shareholders, you being among them. That is how the company is going to determine, based on its shares it has in the market, it's going to split that particular amount and then decide the amount of dividend they're going to be paying per share. And also you as an investor will be able to know what the dividend yield is. That typically happens because the company is a mature company. It is basically past the stage of rapid growth. They're now at a point where they have very clear market share, they have very steady operations, they have very robust systems. They're not really looking to invest much into the systems and expanding and setting up. That is why they are able, or they have the luxury of shoving aside part of their profit and then saying they are going to distribute part of that particular profit to shareholders. Those stocks from those particular companies are called dividend stock. And the amazing thing is that when someone is holding, for example, a dividend stock, they're going to enjoy both possibility of share price appreciation and also dividend, okay? When a person is holding a growth stock, yes, the company's growth potential is extremely higher than a mature company which is paying dividends, but then again, they most likely mainly enjoy share price appreciation, which in ideal setting should be exceeding what the appreciation rate of the dividend stock looks like. I hope you get the difference now, right? I hope by now it is clear. Both of these types of stocks have the potential to build wealth for any shareholder, just that they build wealth differently. As I've said, the dividend stock, you're going to be paid given amount of cash basically for you being owner of those particular stocks through a dividend, which as you can see, it comes in bulk, right? And then for the growth stock, also the way you're going to benefit, remember, the company is utilizing a good chunk of its profit, even all of the profits, to really ensure the operations are scaling up, to ensure it's establishing new systems, is buying technology to ensure that the business is thriving, is opening new branches. All these actions by the company are going to mean that investor confidence is going to continue increasing. It's going to mean that many more people out there who might not be shareholders might want to become shareholders of this company. But then again, remember, it's only a fixed number of shares circulating. With the increased demand of shares of this company, that is going to cause something called buying pressure or demand pressure, therefore forcing the price to go up, right? And if the price goes up, it's going to mean you as a shareholder of this company, despite not having been paid dividend, you're going to see the share appreciate at a higher rate compared to other shares of mature company, which investors are holding. There's no much buyer pressure. Therefore, their appreciation rate is at a slower rate compared to these particular growth stocks. And that is why even it's typical, for example, here, a company has increased even 5 times in its share price in a span of 3 years, assuming it is a growth company which is doing everything right. That shareholder, that investor's confidence and desire for more people to get in those particular shareholding positions is going to make the share price to increase. So either way, whichever of these shares or stocks you are holding, you're most likely going to enjoy benefits. And if you're holding a growth stock, the potential of enjoying higher share appreciation is more compared to the dividend stock. And then with the dividend stock, there is more structure and also more clarity on what to expect because of the history of paying dividends. So having understood that, which of these stocks should a person hold in different age groups? I personally believe when someone is young, right, the ages of 20 to maybe 20 to 30 years old thereabout, right? Basically, I'm talking about the entire spectrum, 21, 22, 32, 34, 38, you name it. Those ages are good for a person to hold growth stocks. And I'm saying so because they have the advantage of time. If the share prices are increasing rapidly, right, it's going to mean their shares can even increase X number of times in a span of a few years. Think about a high growth stock, which has very extremely high value. In case a young person gets into it, they're most likely going to have very many years ahead of them for them to really see this stock increase exponentially. And to give you an example, for example, in case someone bought the KCB shares in mid-1990s, right? Maybe 94, 95 thereabout, when KCB began trading at the NSE. In case they bought the KCB share, right now, the KCB share has increased over 25 times in a span of 30 years. If they put 1 million down on KCB stock in 1995, right now, their investment is worth 25 million. That is how these growth companies or growth stocks look like when someone gets in early. They're going to enjoy the benefit of time. They have a lot of time ahead of them. That is why I think in 20s, 30s, prioritizing growth stocks is something amazing. And then when a person hits 40s, 50s, right, basically inching towards their retirement, I think risk mitigation is important. Because also in the same breath, as growth stocks can give you money, remember also you can lose money. In case the shares go down or even the company closes, you'll end up losing your investment. That is why now these dividend stocks from mature companies also come in handy. I believe now when someone approaches the ages of 40s, 50s, they can start infusing, also at 40s, start infusing at a high rate dividend stocks into the portfolio holding. When they hit 50 years old, have most of their stocks in dividend stocks because you'll have certainty on what to expect. Chances of a big company or mature company going down are extremely rare. Think about it. A company like, for example, BAT, EABL, going down, the chances are extremely rare compared to a startup company in the same sectors. That is the difference. I think that's how a person should be holding these shares depending on their age to their risk appetite and the time horizon they have ahead of them. What do you think? In case you are an investor, which of these types of shares are you holding, and why are you holding specific type of share? And by the way, both of these shares are amazing, as I've explained, and the most savvy of investors out there, seasoned investors out there, enjoy both of these worlds. They hold both growth stocks and dividend stocks. The only thing that they're intentional about their proportions in their portfolio based on their financial goals, based on their age, and also based on what their research tells them. I hope you got a thing or two from this video, which you can implement in your understanding of stocks and also what to do in your investing journey. You are all much welcomed. Look forward to catch up with you in the next video. Cheers and take care.